Hi, this is Steve Dale. Today we're going to cover the purchase or ownership of a home by a special needs trust. And this is really going to go through a lot of fundamentals of housing here. So, part of it is we're going to go step by step on this. Also, for those of you that are viewing, we'll send a link to the playlist of supporting videos for this, because many of the concepts we're going to talk about, we have some short videos that explain this whole concept of, for instance, trying to figure out what your fair share for housing is and that kind of thing. So anyway, with this, we're going to go ahead and get started. Let's get a few things out of the way. This program has been approved for 1 unit of MCLE credit by the State Bar of California here. And with this, each section of the program has a code here that you need to record in order for you to verify that you actually watched the program. Now, if you want to receive credit, what you need to do is download the MCLE credit form here and fill out the proper codes. And in order to do that, what you should do is email Amy at gSPT.org. So that's AMY at gSPT.org. And she can send you that information as well as put you on a list for future programs. Okay? So with that, and then here's basically from our attorneys, the following information is intended as guidance only, and it's not a substitute for legal counseling. And what we're going to learn as we go through this is when we're dealing with housing issues and preservation of benefits, these are really not easy concepts to deal with, and you really do have to do this in a systematic way. So what we're going to cover today is a couple of things. We're going to cover how to calculate your in-kind support and maintenance reduction here and household expenses. And we're going to go through that concept. And this is mostly for folks that are on SSI. We're going to talk about special needs trust paying rent for SSI recipients or paying for shelter issues. Then we're going to talk about paying for shelter issues when somebody's getting Medi-Cal or Medicaid in other states here and not receiving SSI. And then we're going to end on talking about using an ABLE account with a special needs trust. So let's go through this first section, which is how to calculate in-kind support and maintenance reductions and household expenses. Okay, so one of the things we're going to do is the first part of this, we're going through a link that's on the Social Security website here. Now, once again, we'll, for those of you that are watching, email Amy at gSPT.org here. What we'll do is we'll send you this link. Otherwise, if you go to this link and type it out, you're going to see the materials we're about to go through bit by bit by bit. Now, the only difference is that the portions of the program that are with a blue background are copied word for word from the Social Security Administration website, with the only modifications being an update to the 2019 rates here, including California state supplement. So if you're watching this here, for instance, in Denver, and you're wondering why are the numbers higher, it's because California has a state supplement. Otherwise, everything else should be pretty much the same. So let's begin with some real basics. When we're talking about income for SSI, and as we're going to see for Medi-Cal as well, there's 3 kinds of income we have to deal with. The first one is what's called unearned income, which includes cash, gifts, payments from annuities and pensions, alimony and support payments, dividends, interest, rents, awards, and other payments from other programs. And we're going to see that demonstrated over and over again. So just keeping in mind that SSI supplements any other payments of income from any other source here. Some of this will start to make sense. Now, what we're going to see over and over again is that when you're counting income, there's a thing called the $20 disregard. So really the reduction is dollar for dollar after the first $20. We're going to see that $20 disregard come up over and over and over again. I want to give a little clue that you only get one $20 disregard. You can only apply it one time. We'll see that in some of the examples we're going to go through. If we're talking about earned income, you lose $1 for every $2 you earn after the first $65. Now, that's not really going to be our subject today, but as I always like to tell folks, if you have a person with a disability who's working, especially if they're on SSI or Medi-Cal or IHSS or any of the needs-based programs, an absolutely essential website to go to is disabilitybenefits101.org can get into this in a great amount of detail. Something we're going to be dealing with a lot today is the concept of in-kind support and maintenance and the presumed maximum value. So what's important to understand here is that SSI is, when it was first set up, was literally 1/3 for food, 1/3 for shelter, and 1/3 for clothing, which we don't count any longer. Okay, and the concept is that if you're getting assistance with your shelter from somewhere else, it could be a gift from family members, it could be living in somebody's house and not paying fair market rent or any of these other things. The assistance you're getting reduces your benefits dollar for dollar, capped at 1/3 of the federal benefit rate, which right now would be $277. Okay, that usually changes every year with the cost of living increase. So next year it could be $279. You never know what it's going to be. In the year 2019, once again, our presumed maximum value for assistance with food and shelter is $277. Now, to calculate the in-kind support and maintenance, they only look at 10 items here. And this is going to be really important as we go through this. So as we look at this, you want to keep in mind what are those 10 items they count, but also you want to keep in mind what's not on this list. So the things they count are food, mortgage payments, real estate taxes, rent, heating, fuel, gas, electricity, water, sewer, and garbage removal. What's not on the list? Telephone's not on the list. Internet is not on the list. Cable is not on the list. Maintenance of the house is not on the list, okay? And in fact, maintenance of the yard is not on the list. So oftentimes when you're a trustee and you're looking at what can you pay without causing an ISM reduction, you might think about those things if it is actually possible for your beneficiary to pay for those items out of their SSI. So let's go to, once again, the part of the Social Security webpage that talks about in-kind support and maintenance at the link that I had talked about before. In-kind support and maintenance is food or shelter that somebody else provides for you. Now, very typically the way they write this, they're writing it to the SSI recipient here. So we, meaning the Social Security Administration, count in-kind support and maintenance as income when we figure the amount of your SSI benefits. For example, if someone helps you pay your rent, mortgage, food, utilities, we reduce the amount of your SSI payments. Receiving in-kind support and maintenance can reduce your monthly SSI benefits as much as, and once again, $277 here in 2019, depending on the value of the help you receive. So now we're going to go through a whole series of examples that I think are actually pretty excellent that kind of explain how this works. Suppose you live alone and your only income is SSI. Your brother pays your rent of $800. We count this payment as in-kind support and maintenance, and isn't that a good brother, okay? So, although the rent is $800, we limit how much of the $800 we count by using what's called the presumed maximum value rule. So you can think of the presumed maximum value rule as the cap of how much, what's the maximum part that Social Security will reduce the SSI benefits by. The presumed maximum value is 1/3 of the federal benefit rate plus $20, okay? So in this example, here are the steps we use to figure out the SSI amount. What they do is the current federal benefit rate right now is $771. Now, once again, for those of you watching in California, I understand there's a state supplement, so what you're actually receiving is a number higher than that. But all of this is all based on the federal benefit rate, whether you're in California or some other state. So you take 1/3 of the federal benefit rate and divide it by 3, which is $257. And then they add back the $20 disregard to that, meaning the actual reduction would be $277. Now what they actually do is they take the $277 reduction, and if you haven't used it for something else, then they subtract back out the $20 disregard for an actual reduction of $257 here. Meaning that in California, with our total amount that most folks are getting, which is $931.72, you subtract out the $257 from that, meaning that the SSI recipient would only get $674.72. Now, for those of us that are attorneys and trustees, this number is significant also, because if you have a beneficiary who is getting $674.72 or a number really close to that, that means that there's a really high likelihood that this person is getting SSI and they're taking this reduction here, and they're taking the PMB reduction. If they're getting $931.72, they are not taking the ISM reduction. So oftentimes when we're talking to beneficiaries or benefits recipients, we'll ask them, how much are you getting? The reason we're asking that is that oftentimes will help us zone in on what kind of benefits is the beneficiary actually receiving, and are they taking an ISM reduction? Okay, so here, let's go to another example that they give. Suppose you live alone in a home that you own and your only income is SSI. Your son pays your electric bill for $100, your phone bill for $50, and your cable bill for $75. As we had covered before, they don't count the cable bill and the telephone bill here. So that's not going to affect the SSI benefit. So you're free to pay that without a problem. However, they do count the electric bill as in-kind support and maintenance. Because SSI is your only income, we apply the $20 general exclusion, or as I like to call it, the disregard, to the $100 electric bill. Okay, here, meaning that the son paying the $100 electric bill, or even if this came from a trustee, it would cause a reduction of $80 a month in the beneficiaries or the benefit recipients' benefits. So paying the electric bill in this kind of situation really doesn't get much bang for the buck, and it's something you'd want to avoid. We determine your SSI benefits as follows. They take the $100 in-kind support and maintenance payment for the electricity, subtract the $20, meaning it's $80 reduction, and in this case, subtracting $80 from $931.72 is $851.72. Okay? Let's go to another example they give us and dig a little deeper. Okay? Suppose you live with your brother and 2 uncles in a home that your brother is buying and your only income is SSI. Okay? There are 4 people in the household and the mortgage payment is $700. The average monthly bills are $200 for electricity, $100 for water, and $600 for food. The total monthly expenses, if you add that all together, is $1,600. So that would be the household expenses. And what Social Security does when they treat you as part of a household, they take the number of people in the household. In this case, they take the 4 people that are living under that roof, divided by 4, and that means that the fair share for the household expenses in this case is $400 a month. If you were to pay your full share of the $400 for the household expenses, there's no reduction of your benefits, and you would get the full $231.72. Okay. If you were to pay less than $400, so let's say, for instance, you either didn't pay any part of that here, or the trust paid the $400 here, you would be receiving in-kind support and maintenance, and they would apply the 1/3 rule. So let's say the trust paid the full $400. Then what would happen is the $277, which is the presumed maximum value, that's the cap on the most they would take, here would be taken from your SSI, leaving you $654.72. Okay. Now, we have one last example, okay, but I think these examples are very illustrative. Suppose you live in a house owned by your sister who allows you to live there rent-free. You receive $300 a month in Social Security benefits. You pay all the utilities and buy all the food. We determined that the household rent would be $900 a month if your sister rented it out on the open market. This rent-free house is counted as in-kind support and maintenance, and although the value of the rent-free house is $900 a month, they would reduce the benefits by $277 a month. Let's go to the last example. Suppose that we determine your SSI benefits are as follows. So let's say you're getting $300 a month of just regular old either Social Security, or it could be Social Security disability insurance or whatever. To that, there would be the general exclusion that would be applied. And what would happen is the $280 that would result would be subtracted from your SSI. In this case, in California, the maximum SSI is $931.72 for a single person. So we subtract that, the $280, meaning that the amount of SSI the person would be receiving is $631.72. We take the $651.72, and from that we subtract the $277 presumed maximum value. Now the reason it's $277 and not $257 is we already took the $20 general exclusion. You don't get to do it twice. So in a situation like this, what the person would receive would be $374.72 of SSI, keeping in mind that they're still getting the $300 a month of their regular Social Security benefits. Okay. Now I want to mention, and one of the things we'll send out are some separate videos that we've done at the Golden State Pool Trust to explain how do you calculate out the household expenses, because I know if you're looking at this for the first time, this can be pretty confusing here. But what this kind of boils down to is how Social Security counts payments for food and shelter, the 10 items that we saw on the previous slide here, how they reduce the benefits, what the cap is, and different examples of how that might work. So different strategies for minimizing your ISM reduction. If it's possible, pay your in-kind support and maintenance from your SSI, and have your Golden State Pool Trust or have your trustee pay as much of the non-ISM items as possible. Now in California, housing is a little on the expensive side, and a lot of times that's just not possible, and we'll go ahead and just pay the rent anyway and take the reduction. But if we're looking at doing the maximum amount, ideally what we want to do is have the person with the disability on SSI pay for this out of their own SSI without a reduction. If you qualify for an ABLE account, which is the last thing we're going to consider, and part of that would mean that you would have to be disabled before the age of 26. Here, you might want to consider using an ABLE account to pay for the ISM issues as well, and that will be the last thing we'll cover today. Now, this is the first of our MCLA codes here that we want to do. So for those of you that are taking this for credit, write down the number 6346. There will be two other numbers. And remember, to get the form, you can either go to GSPT.org here to the website, or the other thing you can do is you can email Amy at amy@gSPT.org. So let's go to the next section. Can my special needs trust pay my rent if I receive SSI? Okay, so a common myth I hear all the time is that you cannot use a special needs trust for food and shelter. Now that would be kind of silly, because what is it our beneficiaries need more than anything else? They need food and shelter. In reality, a special needs trust can be used for food and shelter for an SSI recipient, but we follow a three-step process here. So the first part out of this is find out exactly what benefits the beneficiary is receiving. Okay, I have to tell you, after doing this for years and years and years, it's really common that a beneficiary will be absolutely certain they're on one program and know they're on another program altogether. And so we follow the Russian proverb, which is to trust but verify here. The second part of that is evaluate the consequences of the distribution on the benefits. And then the last part of that is to report to the proper agency. So let's walk through this. In most cases, when we're looking at the value of the benefits, the cash value of the SSI is important. But, in a lot of situations, it's maintaining the Medi-Cal and related programs like in-home support services that may be of primary importance. The first question we have to analyze is whether or not we are subject to the SSI or the Medi-Cal rules. Okay. For folks that, for many beneficiaries, Medi-Cal eligibility is based on maintaining at least $1 of SSI for Medi-Cal. We're in what's called a 1634 state, which means that if you get at least $1 of SSI, you get your Medi-Cal without a share of cost. You just get it automatically, okay? And I've seen people go to extreme measures to maintain that last dollar of SSI when, quite frankly, I don't think it makes a lot of sense, okay? The other way is Medi-Cal can be maintained independently. And I want to go through some examples later about when and how we might do that. So the next step here, after we evaluate what they're on and the consequences of a reduction in benefits, is evaluate the consequences here. So here, payment in food or shelter from a trust account will reduce the SSI beneficiaries' benefits dollar for dollar, capped at the presumed maximum value. As we went through, currently this year it's $277. Now, in some cases, the loss of the $277 is a minor price to pay. In some cases, this reduction could be very consequential, bordering on devastating. Okay, so it's really, we have to evaluate it depending on the situation. Now, we kind of already went through this, but the 10 things that they look at here are the food, mortgage, real estate, property taxes, rent, heating, fuel, gas, electricity, water, sewer, and garbage. So here's an example where payment of the rent might be advisable. Let's say Jane is getting $931.72 in SSI. She asked Bob, her trustee, to have her special needs trust pay her rent of $1,200 a month. Now, it would be really hard here for Jane to pay $931.72 from her SSI, bordering on impossible here. Once again, we're going to have a balancing act between what is right for Jane, really. So Jane understands that her benefits will be reduced to $277, but she feels that the benefit of living in a decent apartment outweighs the reduction of her SSI. Imagine trying to live in California and have all of your costs covered by $931.72. As I say all the time, I would never want to be one of my own beneficiaries here. So in a case like this, it probably makes a whole lot of sense to go ahead and do this. Okay, so Jane receives the $931. Here's an example where it wouldn't be advisable. So let's say she's getting $931.72, and she asks her trustee to have her trust pay her rent, which is $350 a month. Okay. that would mean that her benefits would be reduced by $277, meaning that she's really not getting a whole lot of benefit. And I think that's a case where we would actually advise not to go ahead and pay any of the food and shelter items, because we're really just not getting enough leverage from paying that to make it worthwhile. Here's another example here, and we do this all the time, of where maybe the payment eliminates the SSI altogether here. So let's say Jane gets $931.72 a month of SSDI here, and she's getting $120 a month of SSI for a total of $951.72, which includes the $20 disregard. Now we go back to this. If you're trying to analyze Jane's benefits and she's not really sure what she's on, but if she happens to be getting $951.72, there's a really good chance that she's getting a combination of benefits. Okay. She asked Bob, her trustee, to have her special needs trust to pay her $1,200 a month of rent. The payment of the rent will cause a complete loss of SSI, but it's not going to affect her SSDI, nor is it going to affect the Medicare that she's going to be qualified for. Now, Bob and Jane may elect to have her rent paid by her trust, but she's going to need to maintain her SSI, her Medi-Cal eligibility, without the SSI. Noted in this example, if Jane elects to lose her SSI and maintain her Medi-Cal independently, she's going to need to apply to her local county Medi-Cal office. Now, here's a couple of things that if I were the trustee counseling her on this, is that maybe there's some other benefits of dropping the SSI altogether. Because in this case, we're paying her rent, and she is going to get $100 and some less. But also, once she's off the SSI, she's not going to have to be as accountable as she was before. Here, we're not going to have any further food or shelter issues. We still have to use her funds for her sole benefit, but there's going to be more latitude and less chance of having a benefits issue. I would urge Jane to drop the SSI and apply for a program we're going to talk about later called Aged and Disabled Medi-Cal here. So let's go back to this. If an SSI beneficiary receives at least $1 of SSI, then they get their Medi-Cal automatically without a share of cost here. And so that's one of the more simple ways to maintain this SSI. But in Jane's case, we're talking about losing it altogether. So we're going to have to look at other types of Medi-Cal. So the first one we did cover is the categorically based eligibility for Medi-Cal or Medicaid here, because we're in a 1634 state. And if you get $1 of SSI, you get your Medi-Cal automatically. But the other program we probably would look at is the Aged and Disabled Federal Poverty Level Medi-Cal. Now, it has the same determination of disability as the SSI, and so in this case, Jane should not have to go through the hassle of reapplying. She just needs to go down and see her Medi-Cal worker and say, hey, I'm dropping the SSI here, but I need to be eligible under another program. Now, another program that's real common is the 250% Working Disabled program, which really isn't applicable in this case, but that's a favorite way of getting on Medi-Cal, especially for folks that are working. It has a lot of benefits. The other program we're going to talk about here is the cost of share of cost Medi-Cal, and what we're going to demonstrate is we want to avoid the share of cost Medi-Cal. In fact, you could call it the share of cost Medi-Cal cliff. We don't want to go over the Medi-Cal share of cost cliff if the Medi-Cal is important to this beneficiary. The last one are Medi-Cal waiver programs. Now, the most common Medi-Cal waiver program we see are for folks with developmental disabilities. They're called the institutional deeming or the developmental disability waiver. But there's other waiver programs like ADAPT for people that are receiving HIV medications and that kind of thing. And there are other Medi-Cal or Medicaid waiver programs as well. That we're not going to go into today here. So here's the last step, is reporting to the proper agency. So if the payment of housing is reportable, you have to report to the proper agency. So if the beneficiary is receiving SSI, then the report has to be to the Social Security Administration. Now, the way we do this is we send a written report to Social Security if we're doing the report here, but you need to notice them that, once again, in this case, the Golden State Pool Trust is paying your shelter here so that they can go ahead and make the reductions. And of course, Social Security can't act automatically, so you may take them a couple of months to catch up. You may get overpaid 1 month, have to pay it back. But once again, you do need to report it. If you're only getting Medi-Cal, so let's say, for instance, what the beneficiary is actually doing here is getting Social Security disability insurance, Medicare, and getting Medi-Cal under the Aged and Disabled Federal Poverty Program, then you would only notice Medi-Cal. There would be no reason to notice the Social Security Administration. It would just confuse them anyway. Okay? Let's go to our second MCLE code here, which is 4538. So let's go to the next segment of our presentation here. Is, can my Golden State Pool Trust pay my rent if I'm only getting Medi-Cal? And is there going to be a reduction in the rent? Okay. Now, once again, we have a separate video on this, but this is an important concept. And I'm actually seeing this applied more and more by Medi-Cal workers all the time. So, for many beneficiaries, Medi-Cal eligibility is based on receiving at least $1 of SSI, but Medi-Cal eligibility can be maintained independently. Okay? And this segment is only for Medi-Cal recipients who do not receive any SSI. Okay, so let's go through this. SSI, we've kind of gone through this slide that there's a number of ways of getting qualified for Medi-Cal. What we're going to talk about here is the Aged and Disabled Poverty Level Medi-Cal and the Share of Cost Medi-Cal. So, to qualify, you have to be 65 or older here to qualify for Medi-Cal under Social Security's, you have to be 65 or older or be disabled according to Social Security's definition of disability. Their definition of disability is the inability to do substantial gainful activity here for that year. So really, it's the same qualification as it is for SSI. Also, you have to have less than $2,000 in assets here, or accountable resources for an individual, or $3,000 for a couple, and meet a resource test very similar to SSI. So once again, they don't count the residence, they don't count your automobile and that sort of thing. It's the same qualification as we saw for SSI. So income as it relates to Medi-Cal. The income limits vary according to family size and program category. The income is determined if a person or family is eligible for free Medi-Cal or Medi-Cal with a share of cost. So basically, part of what this segment's going to cover is when do we go over the share of cost cliff. Income over the limit, or what I like to call the cliff, becomes the monthly share of cost. To qualify, you have to have less than $1,242 accountable income for an individual, or $1,682. And that number was good until March of 2019. So it probably had a slight cost of living increase, but we'll work with those numbers for now. And the beneficiary's monthly income is higher than $1,242. The beneficiary may still be eligible for Medi-Cal, but they're going to have a share of cost. So what you have to figure out is, what is the accountable income level for Medi-Cal here in your situation, and make sure that your income does not go over that. So let's go over something brief about share of cost. Under Medi-Cal, with the share of cost program, the beneficiary must pay the share of cost amount in any month medical costs are paid. After the share of cost is paid, the Medi-Cal will pay the remaining medical bills for that month. Share of cost is only for the months the beneficiary has medical expenses. So if you don't have any medical expenses, you don't have to pay that share of cost. So share of cost is determined by taking the beneficiary's monthly income minus $600 for an individual or $934 for a couple from the beneficiary's monthly income, and any other health insurance premiums the beneficiary pays. So if the beneficiary is paying, for instance, for optical insurance or dental insurance or something along that line, you can actually subtract that from the countable income. So let's go from it for an example. Barbara has a monthly income of $1,300. Okay, Medi-Cal subtracts $600 for a share of cost of $700. Barbara has to pay at least $700 in covered medical expenses and or health care premiums in a given month before Medi-Cal will cover any of her Medi-Cal expenses for that month. The total income generally follows the Social Security rules. Okay, so anyway, I'm going to go back to the previous slide. So in this situation, because her income was $1,300, which was more than the $1,242 that we had covered before, she's subject to share of cost. And once again, because she's subject to share of cost, they subtract out the $600 here, meaning that her share of cost is $700. If her, and let me go back one slide here, if her share of cost had been here, and I'm looking for the actual number. If her income had been less than $1,242 here in 2019, then she wouldn't have had a share of cost at all. Okay, so that's what I call the cliff. You don't, in this example, want to go over $1,242 a month here, because that will kick you into share of cost. And that would mean in this case that Barbara, if she had medical expenses for that month, would have to pay the first $700 out of her pocket before Medi-Cal would pay for anything. Now, the next thing that comes up is, what if we pay for food and shelter expenses for somebody who's getting Medi-Cal, your aged and disabled federal poverty level Medi-Cal, or Medi-Cal based on disability here? And what does that look like? So according to this code, okay, here, this comes from the Welfare and Institution Code. It says income in kind is support and maintenance received in kind from a person, or it could be a trust, other than a responsible relative, for housing, utilities, food, and clothing. Okay, and this is the part that's really important. Income in kind shall be considered income only if the entire item of need is provided by this outside source. Okay, well, let's go back to this. What they're saying is that if you're getting assistance for housing, for instance, let's focus just on housing here, from an outside source here, the income is going to be counted according to a table we're going to see in a minute, but only if the benefits recipient has their entire need taken care of. So let's look at this table. Okay, so what the table says is, let's say the Golden State Pool Trust paid the entire rent here for the beneficiary, then no matter how much we paid, the reduction would be, or the amount that we would add to their countable income would be dollar for dollar the value of the assistance here, capped at $153 for housing. Okay, now if we paid all of their utilities, then we would add another $33 to that. If we paid all of their food, we would add another $86 to that. If we paid all of their clothing, then we would pay $27 of that. Okay, so let's go back to our example. Barbara wants her Golden State Pool Trust account to pay her rent of $1,000 a month. Barbara also receives $1,100 a month in Social Security disability, which means she's probably getting Medicare as well. And she would, and as it says here, she's also getting Medi-Cal under the Aged and Disabled Federal Poverty Level Program. If the trust pays the full $1,000, her countable income would be $1,150 plus $153, which would be a total of $1,253 here of countable income, okay, because they added the $153 here to her countable income. By the way, these numbers have not changed in well over a decade, so even though those dollars are fairly old, and the table is 2009, a decade ago, those numbers are still good. Since $1,253 is greater than $1,242 here, this would kick her into share of cost, which is where we don't want to go. Now, let's say she were to pay $20 of the rent out of her own pocket, and the trust were to pay the whole $980. Then the payment of the rent does not affect her eligibility. Okay, and so this is a good example of really evaluating the situation about how we would do that. Now, oftentimes I know landlords, they don't want 2 checks. What they really want is $1,000. They don't want $20 from Barbara and $20 from the trustee. If you really get into one of those situations, sometimes what we'll have you do is we'll actually have you pay $20 a month back into your trust account, and then we'll apply that towards the $1,000 we're going to pay for rent, just so we can show that you paid towards your rent. The other example we might look at in this case, and I'm going to go back one slide, is that the $153 was just enough to shove her into share of cost. But remember, if we go back to the numbers, we probably could pay for her her utilities here, which has a lesser amount that's added, without a problem. So we'd really have to, it's a numbers game. We'd have to evaluate what we can pay without a problem. And in this case, we certainly could pay Barbara's full $1,000, well, we could pay $980, and we're picking $20. I mean, you could pay the landlord $1, but why be insulting? Okay, so we might have her pay $20 to pay something, we pay the rest. Here, and that's an easy way to get around this. Let's go to the last part of this part of the presentation, which is reporting to the proper agency. So if payment of housing is reportable, you got to report it to the proper agency. If the beneficiary is receiving Medi-Cal, then you need to make the report to the local county health department here. And, you know, we often times, even if they're on SSI, will make the report to the Social Security Administration and Medi-Cal just to be thorough here. So, here. So the last thing that I do want to go through here just is an example here of ownership of a house by a special needs trust. Okay, and we're seeing this more and more because I will tell you, you know, working with families and persons with disabilities, this won't surprise you. The number one issue that we deal with that is greater than anything else is, where will my loved one live, or where will I live, right? And so we have folks, if you can afford it, we have many folks who are purchasing houses and condos and putting those in special needs trusts here to make sure that their loved one has a place to live here. And what I want to show you is a way that you can put the property in a third-party special needs trust here, and possibly being able to avoid some of this ISM issue. Now, this example we're going to go through is based on this POM site, which is SI01120.200. So if you Google SI space 01120.200, this POM should pop up here. And so this is something that you certainly would want to present to the Social Security Administration if you're going to use this example as to how to minimize the ISM. So what, and the POMS is what's of course called the Program Operation Manual System, which are instructions to eligibility workers on how to handle specific situations. So what it says here is that the trustee of the special needs trust owns title to a house as a home for a beneficiary. The home would not be a resource to the beneficiary. Well, that makes a lot of sense. It would also not be a resource if the beneficiary moved from the home. And I want to tell you, in most cases, I really counsel families to not put the home in the name of your loved one with SSI here, with very few exceptions here. Partially, one for the benefit we're going to see, but the other thing is we've run into lots of situations where maybe the beneficiary expects to live in that home the rest of their life, and there may be some reason why that's just not going to work. So as it says right here in the Palms, one of the advantages of putting it in a special needs trust, if they move from this, they're not going to have to sell the house here and do a lot of work with Social Security and SSI and all that here. Those funds will just remain in the trust, can be used for something else. Now this chart is kind of useful, and we can kind of go through this when we're talking about home ownership. You know, one thing about these trusts here, as far as capacity is concerned, here is that if it's in the third-party trust set up by a family member, and let's say the beneficiary doesn't have capacity here, or maybe is conserved, it doesn't make a lot of difference here because the property is owned by the trust, and the fact that and even though the beneficiary doesn't technically own the property, it's not subject to that conservatorship. In a self-settled trust, it's not subject to a conservatorship as well here, unless once again it's subject to court oversight and the court orders that. Okay, if it's owned by the individual, it could require a conservatorship of the estate if the beneficiary loses capacity. So once again, just like anybody else, if you did decide to go ahead and just buy the house and put it in the name of the SSI recipient as their residence, you would at least want to put it in a living trust to not only to avoid probate, but to be able to handle that property in the event that the beneficiary lost capacity. On the sale of the home, here there's no issue as far as what happens to the excess assets of the trust. And so if it was sold within the trust, this property could be used to either buy another home or be used for something else. If it's sold within a self-settled trust, if the house is actually owned by a self-settled trust, the excess funds remain in the trust. The problem with it is if it's owned by the individual, the excess not used to buy a replacement home is going to be counted as a resource, and this is actually incorrect after 3 months. Okay, so that would need to be taken care of. For Prop 13, there would be no reassessment for any of these examples, and for payback to Medi-Cal, there is no payback when you're dealing with a third-party trust because the beneficiary never had a true ownership interest. Here, for a self-settled trust, everything in the trust is subject to a payback. And for a home owned by the individual, there may be a Medicaid recovery for any Medicaid used by or Medi-Cal used by the SSI recipient after the age of 55 for any part of the property that passes by probate. And that's another reason why, if you were going to put it in the name here of the SSI recipient, or if you're an SSI recipient and you want to make sure that the house is not subject to a lien, you'd want to put it in a simple living trust. So let's get back to our example with the Palms. If the trust owns legal title to the house here, therefore the eligible individual would be considered to be living in his or her own home based on a concept that Social Security has called equitable ownership under the trust. Now, between you and I, that has never made any sense to me here, and this is a change that was made a little over 10 years ago. Here, I certainly wouldn't argue with it because I like the result. So what they're basically saying is we're going to treat the beneficiary as owning the house, even though they don't actually have legal title to the house. Before that, what we had to do is charge folks fair market rent here if they were living in a house owned by the trust. And what we're going to see in a minute is that Social Security is saying, well, we don't have to do that anymore. So an eligible individual does not get in-kind support and maintenance in the form of rent-free shelter when living in a home in which he or she has an equitable ownership. So accordingly, an individual with an equitable ownership of a home under the trust does not receive rent-free income. So they're going to treat it as if they own it, even though they don't. Because the SSI considers the individual to have an ownership of the interest, payment of rent by the beneficiary to the trust has no effect on the SSI payments. So now, then it goes on to say that even though the beneficiary has an ownership interest in the home, and if living in the home here does not receive ISM in the form of rent-free income, purchase of the home or payment of the monthly mortgage by the trust is a disbursement from the trust to a third party that results in the receipt of ISM in the form of rent of shelter. So remember that paying for mortgage was one of the 10 things that they count when they're trying to determine the ISM reduction. If the trust used to purchase the home with a mortgage and the individual lives in the home at the month of purchase, the home would be in-kind support of maintenance in the month of purchase, only in the month of purchase. But every subsequent month, mortgage payments would result in ISM of income here to the beneficiary living in the house valued at no more than the presumed maximum value. So once again, if we have the house that's owned by the trust, but the trust is also paying a mortgage, they're going to count the mortgage towards the ISM. For example, a house purchased with a $1,500 mortgage would mean a $277 reduction in benefits. A home purchased with no mortgage would have no reductions in benefits. Okay? Well, so far so good. Well, let's say that our beneficiary actually likes heat and water and garbage and that kind of thing. If the trust pays for other shelter or household items, operating expenses, these payments would be income in the form of in-kind support and maintenance in the month the payment is made. And the shelter expenses are listed once again as the 10 items we've seen before, which is food, mortgage, real estate, rent, heating, fuel, gas, electricity, water, sewer, and garbage removal here. If the trust pays for improvements or renovations to the home here, that's not considered income. So once again, paying for improvements to the home and paying for internet and paying for the landscaping and that kind of thing, there's no reduction, just those 10 items. Now, so with that, now another consideration we often see is what if we're either talking about a trailer or manufactured home or something, or a condominium, okay? And it's very common that we'll have beneficiaries that are living in, trailers or condominiums. One is usually the cost is less, and it's a lot easier in some cases to deal with some maintenance issues. So here's what Social Security says, and if you want to pull this up, if you Google SI space 0835.465, this should pop up. The use of land alone is not a household cost. Thus, if an individual receives land or the use of land without a charge, this doesn't result in in-kind support and maintenance, and that's land that you're using as a residence. Similarly, a third-party vendor payments of real estate taxes, rent, mortgage, or land, or mortgage on the land alone do not cause an individual to receive ISM. Only paying for those things here with the shelter item itself. So a rental space, a trailer space rental fee, which is for a space alone, is not a household operating expenses, okay, for purposes of determining ISM, okay. However, here, if part of the fee is for things like water, sewer, garbage, and that kind of thing, that part of that would be counted as ISM. So here they give us an example, which is really useful here. So let's say James Smith, an eligible individual, meaning he's getting SSI, lives alone in a house trailer that he owns. The trailer is situated on property that his brother Bill owns. Okay, James pays no rent for the use of the land, which we've seen is okay. But Bill also provides water, electricity free of charge to the trailer. Okay, free use of the land results in no ISM, but the value of the food, of the water and electricity here is going to be counted as ISM and cause a reduction of the SSI. So in this case, it would be good to try to figure out what are the water and garbage costs, what's the share, and have, in this case, James go ahead and pay that. Now let's go back into things that we often see. We often will have a situation where maybe somebody's living in a trailer, here a house trailer, and so let's just say that, for example, the trailer space is $500 a month. Okay. Now, the issue with that is if we pay the $500 a month, that should be fine. But what if that also includes water, garbage, and trash? Okay. Well, the value of the water, garbage, and trash is going to reduce our beneficiaries' benefits. So how do we get around that? So part of what we do is we try to figure out what that expense is. So what we'll do is contact the landlord and tell them that if they were paying for this separately, what do we think those amounts would be? Let's say that amount comes to, just to make it easy, $100 a month. Okay, so our total rent space is going to be $500 a month. $100 of that is water, garbage. Here, let's say it's water and garbage. Okay, so with that, what we might want to do is have our beneficiary either pay the trailer space company the $100 and we pay the $400. But just as we talked about before, most landlords, they don't want 2 checks, they only want 1 check here. So let's say instead they pay, I mean, our preference is always to pay the landlord directly, but if that doesn't work, then they could actually pay us the $100 and we would pay the full $500. And we would be able to show if we're audited by Social Security here that the beneficiary did pay that amount. Let's talk for a minute about a condo. Okay, so it's very similar rules. Let's say we have a situation where the beneficiary owns the house, the condo, but let's say that the condo payments are $1,000 a month, and that most of that, if you dig into that, most of that $1,000 a month is going to be for maintenance and things that are not ISM. But let's say in that situation that we determine that $200 a month of that $1,000 is for ISM issues. Okay, we're in the same situation. If our goal is to be able to get the maximum amount of benefits to our beneficiary without reducing their SSI, then what we would probably do is have the beneficiary either pay the $100 a month to the condo association here, and we would pay the other $900, or pay us the $100 to cover that, and we would pay the full $1,000. But we have to be able to show that the SSI beneficiary is paying their fair share. Okay, I know that's a little convoluted, but that's how these things go. Now, let's go through something that's relatively new that might be kind of the joker in the deck where we could get around something like that, which is use an enable account for housing and SSI recipients. Okay, now for this we're going to go through a different part of the POMS, right? So we go back to this. If you Google SI space 01130.740, you'll get the ABLE POMS, and a lot of what we're going to go through here, talking about the ABLE Act. Here, we're going to go through the POMS dealing with ABLE accounts and see how that might help us in this situation. So here's what it says. That, you know, it's going through, once again, housing expenses for purposes of ABLE accounts are the same as they are for in-kind support and maintenance, except for food. Now, any expense you're paying is what's called a qualified disability expense here are QDE. So QDE expenses for housing are for mortgage, real property taxes, rent, heating, fuel, gas, electricity, water, sewer, or garbage removal. Okay, so this is just going through a reiteration of these are the things that count against you when they're determining ISM for somebody on SSI. So what it actually says here in the POMS is it says do not count able account distributions as income here. And this is the part that's really important. Don't count it as income, regardless of whether the distributions are for non-housing qualified disability expenses, housing qualified disability expenses, or non-qualified expenses. For those of you that have been following our different ABLE programs, one of the things about this is that this program is, even though under federal law it says that usage of this program is not to be counted, except some rare situations, by SSI, Medicaid, and even HUD that once again, what this is telling us is that Social Security eligibility workers are not to count payments from ABLE accounts, no matter what they're used for, including paying for shelter items. Okay, and an important concept we're going to see in a minute is also that the ABLE account, when it's funded, immediately becomes the asset of the SSI recipient. So we're going to talk about how to avoid, how to use an ABLE account to avoid an ISM reduction. Okay, so let's go through this. Let's say Belinda has been disabled from birth and receives $931.72 in SSI. A major expenditure for her is housing, as it is for every Californian here. Okay, and she'd like to live in a nice and safe apartment for $1,000 a month. Now, I'm not sure where you would find a safe apartment for $1,000 a month in California, but let's make believe that's even possible. And let's say family offers some rental assistance, and the assistance here doesn't matter if it comes from family or a special needs trust or whatever's going to happen. Well, let's go through her options. Let's say her parents were to pay $1,000 a month directly to Belinda and say, well, Belinda, you just go take this $1,000 and go pay your rent. That's not going to work because that's going to be counted as unearned income, and it's going to completely eliminate her SSI. So that doesn't work. Let's say that they decide we're going to go ahead and pay the landlord directly without giving it directly to Belinda. Well, that's going to count as in-kind support and maintenance, and it's going to be reduced by the presumed maximum value, which is $277. But here's where the magic happens. Let's say the parents contribute $1,000 a month into her ABLE account, okay? And just remember, the moment that it went into the ABLE account, it became Belinda's money, the instant. Then let's say that the ABLE account here pays the $1,000 a month directly to the landlord. There's no reduction in the SSI because Belinda paid her rent with her own money. Okay, and that's why. So we go back to this and they reiterate here, what are the 10 items that we count? You know, when we're talking about doing an ISM reduction. Now, the one thing on the top of the list, and we're going to be hearing from Amy in a minute, so I'm going to cut you off at the pass here, is we've had this ongoing discussion about whether or not food is a QDE, and I think what we've determined is there's a lot of confusion, but functionally it is. Technically it isn't, okay? So when we're talking about the 10 items to talk about ISM, we're going to include food. Technically, it doesn't include food, but as we've gone through in other situations, food is functionally a QDE, although my advice is, since there is so much confusion out there, if it's possible for your beneficiary to pay their own food out of their own SSI, that's the safer way to go. Let's go for our last code, which is 1693. 1693. Here we're going to go through our last scenario, and we'll see if we have some questions. We'll try to take some here, but let's just run through this. So this is going to be kind of like putting everything together. Sue Casa wants to provide her daughter Mia with a home to live in. Sue is concerned that if she puts the property in Mia's name, it will be subject to a lien. Now, we kind of covered that. If that's the only concern, you could put the house in a living trust, and the lien or the Medi-Cal recovery here is only for any Medi-Cal use for medical purposes after 55 that goes through probate. So you could put the property in a simple living trust and avoid that. That's not the end of the story. Let's say additionally, if Mia were someday to unable to live in the house and that it were sold, it could interfere with her benefits. The other advantage of putting it in a trust is it also won't be subject to creditors if there's a problem down the road. So Sue is able to purchase the home, and rather than give the title to Mia, she titles it into a third-party special needs trust. Now, as we might remember, what it says in the POMS is if an eligible individual does not get any kind of support and payment of getting rent-free shelter, if she's living in a home that has an equitable interest. We had covered that before. Accordingly, an individual with equitable home ownership under the trust does not receive rent-free shelter. Well, that's all fine and dandy, but what if she likes, heat and electricity? If the trust pays for other shelter and household operating items, these payments would be in-kind support and maintenance in the month that they're made. So Mia can live in the house without paying the rent because she has an equitable ownership interest, but she's going to have a hard time paying the taxes and utilities without some sort of an assistance. So Sue Casa here transfers enough funds in Mia's account either monthly or annually to allow her to pay the taxes and utilities with no reduction in benefits. Sue also establishes a Golden State Pooled Trust account for Mia here so that to continue making contributions to Mia's ABLE account in the event that she passes away or loses capacity. Both Sue and Mia feel much more secure and feel that she has the best of both worlds. Sue has provided a residence, and if Mia were unable to remain in the house, it could be sold and used for her needs without disrupting her benefits. If Mia were to be sued, the assets in the Special Needs Trust are protected. So with that, so one of the things that hopefully this shows, and I know there's a lot of moving parts in this, but once again, there's a lot of situations here that if our beneficiary is eligible, we might be able to pay for these ISM issues for a person who is on SSI here without taking that reduction. I'll make one last mention, and then Amy, do we have questions? Okay, of course we do. Which means that somebody is watching, so that's good. Here, something that we just got, and we actually didn't cover today, Section 8. Here, partially because it's such a quagmire to add that on top of everything else is difficult, but we just got a verification from HUD, something that advocates have been asking for quite some time, verifying that payments from an ABLE account are not counted as housing. So for a lot of folks that are on HUD or housing programs, this will also be a great way to minimize the amount of their co-payment. So last thing real quick, here we have 2 more slides and then we'll get to the questions. This is qualified for 1 unit of MCLE credit, and if we go an hour and a half, who knows, maybe we'll even nudge it to 1.5 hours here. But to participate here, you need to write down the codes here on the sheet. Now, to receive notices here for future programs, please email amy@gspT.org. And with that, Amy, here we have some time for questions. So do we have questions?
Yeah, we were probably about 10.
Oh my goodness. Okay, well.
Is maintaining Medi-Cal essential for group homes funded by the regional center?
That is a good and sometimes inconclusive question. So the general answer is that under the Lanterman Act, that is an entitlement here, and whereas the trust shouldn't be counted, it's not a Medi-Cal based program. Now, if you're receiving in-home support services and that kind of program, it would be essential. So the general answer is that under the Lanterman Act, and we're talking about for regional center clients, here, or somebody with a developmental disability. Maintaining the Medi-Cal shouldn't count, but once again, you'd want to check with your local regional center because they may have interpreted it differently. They probably want you to be on Medi-Cal, and there's a lot of reasons why Medi-Cal is good, not only for the beneficiary, but also to offset a lot of costs of the regional center. But if we get back to the question, for in a group home, is it absolutely essential that you be on Medi-Cal? Once again, the Lanterman is an entitlement, and my understanding is it's not absolutely necessary. Before you take that to the bank, here I would check with your local regional center, and if there's an issue, here we would certainly try to help you, or at least get you in touch with one of the consultants that we work with who would help you try to straighten that out. Two mushy answers so far. What else?
This one I think is more straightforward.
Okay.
I think they're just looking for confirmation. We're applying for SSI for our son. We have a third-party special needs trust and are planning to purchase property. The SSI worker said we will probably be denied because we have to write that on his death, funds are given back to the state. Is this correct?
Absolutely not correct, and I think that illustrates something here. And Amy, you know this yourself. Social Security makes a lot of mistakes and misinterprets these things a lot. So the reason, because in this case we're talking about a third-party trust, it's not subject to a lien or anything. So in a case like that, if it's held by a third-party trust, it would have no effect on the benefits, and it's not subject to a lien. Right?
Yeah, as we all know, SSI workers are often incorrect.
Yes, I think in a lot of cases, and a part of this, I don't think we're sharing anything. Amy has firsthand experience with that as the advocate and the repayee for her own son, right?
Correct. I had to go back a few times to convince them that I could use an ABLE account to offset his, to show that he was paying his full share of ISM.
And I would say here, it probably is helpful when you have anything out of the ordinary. If you have the part of the POMS that actually is determinative in this case, you might want to take it with you and highlight it here. But I mean, once again, you have to keep in mind that the Social Security Administration, as well as Medi-Cal, it's a huge organization. They're under a lot of pressure and all that, so just trying to be kind about it. Here, there's a lot for them to keep up with, but just because your worker told you something doesn't mean it's true.
This is another clarification. Is a home sale, is it considered a resource after 6 months, or if owned individually, or 3 months?
I believe it's 3 months, and I will make sure we check that here. The thing that gets confusing is that if you have an overpayment, you have so many months to spend. I believe that's 6 months. I may be inverting it here. So one is 6 months and one's 3 months.
Okay. Can trustee not charge rent without counting as ISM because the beneficiary is paying his share of property tax in lieu of rent?
If we're talking about an SSI recipient in a home, in a residence that's owned by the trust but not technically owned by them, they don't have to pay rent, period, and it's not really determined. It doesn't really matter if they're paying the property tax or that kind of thing. The problem with it is all property is going to have property tax, right? Somebody has to pay it. So let's say the property tax is $300 a month, if it works out to that. If the trust pays the $300 a month, it's going to count as the ISM. You're going to have the $277 reduction. So what you'd have to look at is not just the property tax, but anything else the trust is paying that's ISM, and try to figure out first, is it possible that the beneficiary could pay that from their $931.77 here, and if not, are they eligible, and could we boost that amount of funds that they could pay by the ABLE account amount? Otherwise, they're going to take the reduction. So just to go back to this, payment of the property taxes if you're really shooting for getting the maximum ISM, the maximum SSI without the ISM reduction. Here, it is somewhat of a numbers game, and you're going to have to figure out all those other expenses, including a mortgage. In most cases that I've seen, if there's a mortgage on the property, there's just no way to make this work. So anyway, there you go.
And this was just a comment, and I'm sure you can substantiate that, but the question was about ABLE accounts.
Yes.
That it's capped at the annual gift exclusion limit, now $15,000.
And right, so ABLE is still capped at $15,000 a year, whatever the gift tax, federal gift tax exclusion is. So eventually it'll go up to $16,000. I doubt if it will this year. Here, although with the economy, it's impossible to predict. And there's a number of bills in Congress. The one that's most likely to get passed is the one that would raise the age to 46. I don't think anybody really expects that they're going to increase the amount that can be contributed, at least this year or in the near future. But predicting what Congress can do, what it's going to do, is kind of hard, in a situation like this.
Okay. Can a home be distributed from either a first-party or third-party special needs trust to an individual beneficiary as an exempt resource?
Okay, so the question is, and let's cover them both. From a third-party trust, could you just say, go ahead and give the house to the SSI recipient beneficiary here? And the answer is, there's no reason why you can't, right? I would just, if I were the attorney on this case, I would just ask them, and I probably would do this in writing, to really just consider that once you distribute it out, you can't put it back into the trust. Here, and if that property has to be sold, you're gonna have to deal with whatever's left over, whatever isn't used to buy the new property, and put it in a self-settled trust, spin it down, or something. And there could be some creditor protection issues. On the other hand, there may be a good reason to do that. On a self-settled trust, and this would partially depend on the states, because my understanding is that in some states, the Medicaid offices would not want you distributing an exempt resource, which is a house that they could be collecting the lien on eventually, or individually to the beneficiary. Now, I think that's wrong. In California, we do that all the time. And in fact, I run into situations oftentimes where the house is owned by a self-settled trust. And there may be a number of reasons why it would be a lot better to put it in the hands of the beneficiary, not the least of which is that the Medicaid or Medi-Cal recovery on a residence outside of the trust would be for any Medi-Cal used for medical purposes of the beneficiary after the age of 55 for any asset that passes through probate. So if I were to do that, I would also urge that it go into a living trust to avoid the probate, to avoid the lien. Yes, you could do that. Now, here's the problem you would have is if this is a court-monitored trust. And this is an argument that we've had with many courts, and we've seen some courts do this and most not. We have many situations where maybe the home is owned by the trust. Maybe we have a lot of family members that are assisting that beneficiary here. And we get a lot of folks who have given up their lives to take care of a loved one with a beneficiary, which I absolutely applaud. God bless you for doing that here. And the problem is the beneficiary dies, and if the house is owned by the trust, it's going to be lost to the lien. Okay? So in that situation, if it's a court-monitored trust, we might petition the court to maybe put the house in a conservatorship here, or maybe into an irrevocable trust owned by a conservatorship or something. The reason to avoid that lien and to allow our beneficiary to be able to do what any other Californian can do, which is to own the home themselves, put it in a living trust, and avoid that lien. But there's an equitable part of this, is that, once again, we've had some very sad situations here where we've had, for instance, a child with a disability pass away, and not only do they lose the child, but they lose the home. Okay, so owning in a first-party trust is probably the worst option possible as far as the lien is concerned, because the lien is for any Medi-Cal used during their entire lifetime, used for medical purposes. And the way that California is interpreting that, they're interpreting that really liberal, okay? It would be so much better to be able to hold it either in a trust or even a conservatorship, if that can be done without triggering the lien. And we've had some courts that have allowed that. Most courts have turned us down. So like a lot of things. Third-party trust, definitely you could do it. Consider the other things. First-party trust, if I were counsel and there was no reason not to, like a capacity issue or something, I probably would counsel to do it with little hesitation. If it's a court-monitored trust, I would ask the courts.
Okay, a question came up about ABLE accounts. Two questions. Are ABLE accounts different in each state, and is there a reason to have a California ABLE account?
Well, there is a Dante Allen is watching, but let's go through this. Okay, let's tackle the first one. Are they different from state to state? And the answer is no and yes. They're under the same rules, so the rules are basically the same from state to state, but they're operated very differently from state to state. Fees are different, and I know a lot of folks have been focusing on the fees, quite frankly, and maybe it's because I'm not paying the fees. The difference between paying $20 a month or a year and $50 a year, I just don't see that as a big deal. The investment options are going to be different, although if you look at the investment options for most of these programs, it's a whole series of very conservative options, as they should be. What are the differences between ABLE programs? And this might actually get us into CalABLE. One would be the method of distribution. So, for instance, some programs, and we've been using the Ohio Stable program for quite some time, partially because they have a debit card connected with their program, which essentially is a TrueLink card, and that gives greater independence to folks. Now, CalABLE will have theirs. They're going to have one by another vendor up and running, we're told, in July here. So, for those of us that are watching, I'm waiting to see. I don't think I want to be the first program to have somebody use a CalABLE card. I think maybe we'll wait a month or so and see if there's any bugs to be worked out. That'll change as time goes on. Sometimes the customer, some ABLE programs are better at customer service than others. I will tell you, the customer service I've seen at both CalABLE and the Stable program have both been excellent here. But once again, I hear things about other programs here. Those are the main things that we look at here as far as choosing programs. Is there a reason why you would want to use a CalABLE program? Well, there's another number of things, not the least of which is we are Californians here, and we do want the program to work well. An ABLE program, a CalABLE program, will not be subject to a lien here because that's been legislated out. I will tell you, there's an argument that federally that may or may not be valid, but you know what? I think the chance of that being reversed is small, bordering on not at all here. So that's certainly important. There's things along that line. For most of what we do at the Golden State Pool Trust, we're doing money in, money out accounts. So whether there's a lien or not doesn't really matter a whole lot. But I would say, CalABLE is an excellent choice. I would actually encourage people to consider CalABLE, and we are going to start using CalABLE ourselves here, but part of it is a lot of our beneficiaries actually use a card, so until we have the card, we're going to have problems as far as how we're going to get distributions out to folks. So anyway, do we have any other questions? Or
We'll end maybe with my favorite question. Can a beneficiary use their own ABLE account resources to purchase food, a basic living expense, with their stable debit card?
Yes, there we go. Okay. So here's where the confusion comes in, and since it's not technically an ABLE program, but you can see how ABLE keeps dominating the discussion. If you look at the qualified disability expenses, what it says is here is, in fact, let me go back up. It doesn't mention food, okay? I'm going to go back to this one part of the POMS, and this is going to illustrate this, and this will be an interesting way to end this. So what it says is, oh, there we go. That's what I'm looking for. Now, the Department of Treasury is working on their permanent regs, although I would not be surprised. It is not unusual to have temporary regulations in perpetuity here, and I know that's an oxymoron, but welcome to government administrative law. And so what happened with a lot of the information is that there was something written by the Department of Treasury that described what a QDE is, and it started off by saying a QDE is basically any basic expense that helps enhance the quality of life for an able beneficiary. Somebody read that and said, I really like that. So they added basic living expenses to the list of QDEs. Okay, now, when we get to that here, if you start adding to what's a QDE here, and if your standard is any basic living expense, what is not a basic living expense, right? And the only thing that it seems like able advocates can come up with is gambling is not a basic living expense, apparently, even if you live in Nevada here, and nor are illegal drugs. Okay, so way to really tackle this twofold is that I think it's commonly accepted at this point that a food is a QDE because it's a basic living expense. Well, let's just go one step further. Let's say down the road it's determined that food is not a basic living expense because it's not on the technical list of what a QDE is. What this says here to the Social Security workers and CMS, which oversees Medicaid, has the same thing. It says, do not count distributions from an ABLE account as income, regardless of whether the distributions for a non-housing QDE, a housing QDE, or a non-qualified expense. So what that's basically saying is, even if you pay for this with food, Social Security is not to count it as in a reduction of benefits. So there's nothing further on that. Where's the danger? Okay, well, let's say in order for our beneficiary to actually have a penalty from the Department of Treasury, our beneficiary would have to be audited by the IRS, by the IRS, and the IRS we'd have to have an IRS auditor who's fluent and able, and I think the chance of that is greater than zero. And that auditor to say, I don't really think that that a basic living expense is a QDE because it's not on the list. I'm going to impose a penalty here for this individual. And if we were to go through what the penalty is, it's laughable. Going back to this is the advice I give people. If you can pay for the food comfortably out of the SSI, that is the safest thing to do. Okay? If you can't, then I would pay for it from an ABLE account, realizing that there's a heck of a lot of confusion out there here, and you may find yourself having to argue with the eligibility worker, or worse, if you go through a fair hearing here, maybe having Social Security determine that it is subject to an ISN reduction here. You would have to make the argument that we have right here that it doesn't matter what you did, there should be a reduction, but let's just face it, going through that hassle would be a mess. Otherwise, I'm authorizing payments for food from a ABLE account with little hesitation, just with the warning that I think technically it's a QDE, but it doesn't mean that you can't have problems down the road. So how's that for a last convoluted answer? Here, boil it down. If you can, pay for the food out of the SSI. If you can't, once again, I think the chance of a problem are small, but I don't think it's zero. Okay, so with that, Amy, I think the last thing we do want to cover here is that we have a special event. Our next program coming up is going to be June 18th. And what we're doing, this is part of the Life Passage Planning Program. For those of you in Marin County, whether you're a fiduciary, an attorney, this is really meant for professionals. We're going to do a 3-hour taping at the Court of Madera Center in Court of Madera on incorporating care management via the Life Passage Planning System here with a focus on Marin County. The program will be recorded, will be available to anybody, so no matter where you are, as your Life Passage Planning agency is open. So EBI, which covers Alameda and parts of Contra County, the county's been running for some time. This program is going to be featuring Integrated Community Services, which covers Marin County and San Francisco County. We're going to talk about how you would incorporate that, what language you would put in your trust, and different ways of assessment. And we do have room for a studio audience of about 20. I think we have about 10 seats left, something in that range. Here, so if you're interested, you wouldn't want to, as always, email Amy at GSPT.org here, and Amy can make sure that either you're able to sit in the audience here, or that you'll get the link when this is all done. And I think the finished program will be valuable to anyone. And just as a push, we'll be doing more of this. This Life Passage Planning Program, I think, has the possibility of giving us top-notch, affordable care management to folks who've never been able to get this before. And so we're really excited about this. You're going to be hearing more and more about that. With that, I think that we've pretty much come to the end of our time here. I want to thank you for watching here. In order to, we'll say this one last time, we invite you to sign up for our YouTube channel, as well as sign up for announcements for this and future programs, and you can do that by emailing amy@gSPT.org. With that, DJ, I think it's a wrap.